Okay, dear students, let's just start the live revision class of FM. Today's topic is business valuation. And at the end of today's class, I'll give a small homework as well. And on that homework, we'll conduct the class, inshallah, in the coming week. Let's just start business valuation. Okay. Basically, what are the main reasons why one organization acquires another company? The main reason is synergistic benefit. For example, if APLC wants to acquire BPLC, so the reason is synergistic benefits. So the main reason of one organization buying another company, getting the control of another company is synergies, to get the benefit from the synergies. It is not always that APLC is taking over the BPLC. There could be a merger that A and B, they can just merge together. Again, the main reason of acquisition and merger is synergies. Now, there are different types of synergistic benefit. One is revenue-based synergies. Revenue-based synergies means the combined revenue of combined company will be more than the total of individual revenue of A and B. The theory of revenue-based synergy says, for example, if APLC revenue is 10 million and BPLC alone is generating 5, if I add them, I'll get 15. But due to the concept of revenue-based synergies, if they become one company, they work together, then they will be having a revenue more than 15 million. That is revenue-based synergies. So one type of synergy is revenue-based synergy. There's another type of synergy which is cost-based synergies. Cost-based synergies means combined companies' operating costs will be lower than the total operating costs of each company. Now there's a question how cost-based synergies can be achieved. Actually, cost-based synergies can be achieved by eliminating the duplication of functions. For example, both the companies are having marketing department. So obviously after merger, we don't need two marketing departments. One is enough. Assuming both the companies are having R&D department. So after merger, I don't need two R&D departments. One is enough. This is, we are achieving cost base synergies. Okay. This is how we achieve cost based synergies. And the last one is financial synergies. Now, what do you mean by financial based synergies? Basically, when APLC acquires BPLC, it will become a bigger group. When it becomes a bigger group, it becomes easier to take the loan at a lower interest rate. So that is financial based synergies. In fact, let's say APLC has acquired BPLC as well as CPLC. The bigger the group is, then there is also a possibility that most of the time finance could be arranged within the group. That is financial based synergies. So the main reason of merger is to get the synergistic benefit. But this could also be the reason of demerger as well when synergies are not achieved. So basically, before the merger, everybody was thinking that 2 plus 2 is going to be 5 because of the synergies. But after merger, this is before merger and acquisition. But after merger and acquisition, if 2 plus 2 becomes 4.5, then most of the time the merger results in a demerger. Why it results in a demerger? Number one reason is over estimation of synergies. When you overstate the synergistic benefits and actually you're not going to achieve it, then it creates the problem. Another reason of demerger is cultural clashes. So these are the reasons why the world has seen so many demergers also. Now we need to learn basically how do we value a business, how to value a company. Obviously, when we are going to value a company, there are number of methods available to value the company. And in different situations, different methods are suitable. Simply one method is not suitable to every company. Depends on the nature of the company. According to that, there are number of methods which suits them. So we'll be discussing each and every method. Let's start from the first method of business valuation is net asset based valuation. Now, what do you mean by net asset based valuation? It's very simple. We are talking about net assets. Simply, we are saying total asset minus total liabilities equal to net assets. And we know that net assets, they are equal to equity. So simply, we are saying your business value is equal to your net assets. Okay, now please listen carefully. How do we calculate the value of net asset? There are different possibilities. One is we calculate the net asset value on the basis of carrying amount. Carrying amount means which is written in the balance sheet. So whatever is written in the balance sheet, just take total asset minus total liabilities, you will get net asset. Another way of business value on the basis of net asset is fair values. But in case of fair value, examiner will give us the fair values, okay? Examiner will give you the fair value. For example, what is the fair value of property, plant and equipment? What is the fair value of the machinery, land and building? It will be given to you. Then I'll be using the fair values. Now, there's one more method of valuing the net asset, that is breakup values or net realizable values. Breakup values, net realizable values. Now, what do you mean by net realizable values? Please try to understand. And when do we use these breakup values and net realizable values? Basically, when going concern assumption of the business is not valid, because we cannot see that business will be continue in the foreseeable future. If the going concern of the business is not valid, then we go for net realizable values. Net realizable values means, for example, we are selling each asset separately. That is net realizable values. And normally, when we go for net realizable values, then there's a possibility of getting a little bit good amount against your land and building. Or when it comes to inventory, you will be getting very less amount, very low value, because everybody will be having the information that the company is just over and you have to get rid of the inventory. But you just need to know one concept. When do we use net realizable values? When basically going concern assumption is not valid. Now, one more concept. Net realizable value will give you the minimum value of the business. Obviously, less than that is not a question at all. If examiner asks you a question, calculate minimum value of the business. Another name for the minimum value is floor value of the business. Logically, the floor value of the business will be calculating by using net realizable values. There's no question, nobody will be selling the business less than net realizable values. Now let me make it more clear. If your examiner is asking you a question, what is the floor value of a, let's say, private company? The private company floor value will always be equal to net realizable values. It gives you the floor value. Now, another question. Now, this is a very important question. The question is, when will you advise a business to go for net asset based valuation? There are so many methods. Obviously, net asset based valuation is not the one which is preferable. But the question is, when do we advise, when it will be beneficial for a business to consider net asset based valuation, and when it will not be advisable to a business to consider net asset based valuation? Now, please listen carefully. If your company is having high tangible value assets, repeat, if your company is having high tangible value assets, then we will advise them that you should consider net asset based valuation. Example could be investment property companies. I'm talking about real estate investment trust. So, real estate investment trust should be valued on the basis of net asset based valuation because they are having high value tangible assets. But if there is a service based company which provides services, normally service based companies, they will not be having high tangible value assets. Now just imagine there's a company which is a service based organization, they are providing services. Normally they will not be having a very high valuable plant and machinery. They're not doing any manufacturing. They're just a service-based organization. They provide services. So normally when I'm dealing with a service-based organization and my examiner is asking me that should we go for net asset-based valuation? So normally I would say not suitable for this company. Because a service-based organization normally will not have high tangible value assets. But if you ask me the real estate investment trust, yes, I'll say go for net asset based valuation because this organization is having high tangible value assets. So that is all about. Another thing is net asset is equal to equity, and you should know that business value, when we say it is equal to equity, means I'll take share capital. If there is any share premium, I'll take that. We'll add all the reserves. So basically your business value is equal to equity. There's a possibility that you need to value the business on the basis of net asset, and examiner has not given you the information of asset and liabilities. It's okay. If I have the information of share capital, share premium, and reserves, that is equal to equity. Now listen carefully. Even your examiner gives you the irredeemable preference shares, while valuing the business, normally irredeemable preference shares, we will treat them like a liability. Now the question is why we are treating them like a liability, because when business liquidates, then preference shareholders, they will be paid before the ordinary shareholders. On that basis, we are saying treat these preference shareholders as a liability. So in case when you are valuing a business, there are preference shares, simply they are liability. So business value, if examiner does not give us any asset and liability, so it will be equal to share capital, share premium plus reserves. Now let's go ahead. There's one more way to value the business, that is dividend valuation model. Dividend. We do use dividend valuation model to value the business. Simply P naught is equal to D naught 1 plus G K minus G. P naught, we know that is current share price. Per share. Current share price D naught. Current dividend per share. Current dividend per share. G is the annual dividend growth rate. G is the annual dividend growth rate. And in dividend valuation model, we know that we assume that annual dividend growth rate is constant. Okay. D naught 1 plus G means D1. D1 means next year expected dividend. This is like, if it is D24, 1 plus G will give us D25. By using dividend valuation model, if you have calculated P naught, so by using this P naught, we can calculate business value through market capitalization. So business value is equal to, we'll take issued shares of the company into P naught. Another name for this issued shares into P naught, another name is market capitalization. If examiner is asking you to calculate market capitalization by using dividend valuation model, first we'll be calculating P naught, then that will be multiplied with the issued shares. Market capitalization is equal to issued shares into P naught. Now, another important concept. Look at the formula. P naught is equal to D naught 1 plus G K minus G. Or if we replace D naught with the annual dividend, then we'll directly get the business value. Business value is equal to annual dividend into 1 plus growth rate K minus G. So this is annual dividend, annual dividend. So annual dividend 1 plus G upon K minus G. That gives you the business value. Okay, now in dividend valuation model, sometimes what examiner does, examiner gives you the information like this. Let's say there's a question T1, T2. If examiner says dividend per share is 0.4, 0.43, 0.47. And this, after this, from T4 till T infinity, it will keep increasing by 3%. If information is given you like in this format, which I've just written in front of you, examiner has given us the K 10% and the requirement is P naught. Now what you have to do, we have to just calculate present value of all the future dividends. Sum of present value of all the future dividends, there will be the P naught. Now, obviously, I need to calculate the present value of the dividends. So the discount rate is K. 0.909, 0.826, 0.751. Now come here. Dividend 1 plus growth rate, look at the formula. Dividend 1 plus growth rate, K minus G. K is 10% minus the growth rate. Now, we are not using this formula from T1 till T infinity. We are using this formula from T4. So whenever students, please listen carefully, whenever you need to use this formula after 2 years till infinity, or maybe after 3 years till infinity, then in that case, what do you do? Whatever the result comes, that will be multiplied by the discount rate of the base year. Base year means previous year. So by using this formula, whatever you get, that will be multiplied by with discount rate of the previous year. If we are using dividend valuation model formula from T1 till T infinity, then there's no need of doing anything additional. But whenever we are using this formula, for example, from T3 till T infinity, T3 means the discount rate of the T2 will be used. If we are using this formula from T5 till T infinity, then discount rate of T4 will be used to calculate the present values. Okay, let's see what are we getting. 0.4 into 0.909. I'm getting 0.3636. 0.43 into 0.826. I'm getting 0.35518. 0.47 into 0.751. I'm getting 0.35297. Now, first you have to solve this. Whatever answer comes, that will be multiplied by 0.751. So let me use the calculator. 0.47 multiplied by 1.03. Then in the denominator, we have written 0.1 minus 0.03. So it becomes 0.07. So I'm getting the result. The answer of 0.47 into 1.03 divided by 0.07, I'm getting 6.9157. Let me recheck. So we should not be making any error. Otherwise, those students, they will be watching the video, they will have the issue. That's perfectly all right. Now 6.9157 will be multiplied with the discount factor of base year. 6.9157 into 0.751. I'm getting 5.19369. Now we'll add all of them. The sum of all these present value will be P naught. 0.3636 plus 0.35518 plus 0.35297 plus 5.19369. 5.19369. So I'm getting 6.26544. That's the P naught. Okay. Now there's one more method to value the business. That is P ratio based. And this is very important. P ratio base valuation. Price earning ratio based valuation. Basically, what is the formula of P ratio? Price earning ratio. Current share price upon EPS. Answer of P ratio comes in times. Now keep watching, please. If I have P ratio, multiply this with EPS, I'll get P naught, which is the current share price. Now please try to understand. Earning per share into P ratio gives us the share price of current share price. It gives us value of one share. P ratio into earning per share gives us the value of one share. Now, look at EPS formula in FM. In FM, of course, we are not using IAS 33. So in FM and AFM, calculation of EPS is very simple. We simply take profit after tax and we divide this with the total ordinary shares. Total ordinary shares. Okay. So it means earning per share. By looking at this formula, we can say this is profit after tax per share. Earning per share is logically a profit after tax per share. Okay. Now, if I replace this earning per share with PAT, so we will not have P naught, then directly business value, we will have directly business value. Business value is equal to P ratio into profit after tax. Now let's make it more, I would say, logical. Business value is equal to, instead of P ratio, I'm writing a suitable P ratio. I've changed the term from P ratio to suitable P ratio. We'll discuss what do you mean by suitable P ratio. Then instead of PAT, suitable P ratio into, when we say PAT, you have to actually take the sustainable earnings. Of course, sustainable earnings after tax. Now, what do you mean by suitable? And what do you mean by sustainable earnings? Now, please listen carefully. Now, let me explain suitable. There is a possibility that we need to value a private company on the basis of P ratio. Obviously, if I need to value a private company on the basis of P ratio, private company does not have a P ratio. Why private company does not have a P ratio? Because private company does not have a P naught, does not have a current share price. But still, examiner is asking us to calculate business value of a private company by using P ratio method. So what we have to do, first of all, we have to see in the question, examiner will give you a similar size listed company. Step 1, we will calculate similar size listed companies P ratio. Second point, P ratio actually shows confidence of the shareholders. So obviously, on listed companies, confidence will be more as compared to private companies. On listed companies, shareholders, they have more confidence as compared to private companies. So what you have to do, whatever P ratio we have calculated, we will reduce that P ratio to make it suitable for a private company. For example, you can take 80% of listed company P ratio to value a private company. You can take 2/3 of listed companies P ratio for a private company. But the main concept is private company will have a lower P ratio as compared to the similar size listed company. Why? Because on the listed companies, shareholders, they have more confidence as compared to the private company. That is the meaning of suitable over here. Another, now what do you mean by sustainable earnings? Now, sustainable earning means there is a possibility that your profit after tax, which examiner has given you, if it is having the impact of non-recurring items, so you have to exclude the PAT from those. Simply those non-recurring items will be excluded from this PAT. Now, what do you mean by non-recurring items? If examiner says in this PAT, let's say, there's a gain on the disposal of property, plant, and equipment. So obviously with that gain, PAT has increased, but you will not see that gain every year. And I'm going to acquire that business, which is not going to have the gain on property, plant, and equipment every year. So why valuing that business? What I'll do, from that profit after tax, I will deduct that profit. I will deduct that gain on disposal to make it sustainable earnings. So another example is if I need to adjust the PAT to make it sustainable earnings, to get the sustainable earnings, so I will adjust the PAT. For example, assuming your company wants to, APLC wants to acquire BPLC. Okay. Just 2 minutes break. Azan is sounding. Just 2 minutes. Okay, sustainable earnings you were discussing. Now, there's a possibility that APLC wants to acquire BPLC. Okay. And let's say there is XYZ person who is working in BPLC as a manager, or let's say as a finance director. And we know that as soon as APLC will acquire BPLC, so we know that finance director will leave the BPLC due to any reason. Let's say he does not like us, he does not like our admin, whatever it is. And let's say finance director is getting paid $1 lakh per annum, and we know that that is very low salary he's getting just because of his good experience with the company or just whatever is the reason, but he's getting less than what the market is offering him. And we know that as soon as this FD is going to leave the BPLC, we will hire someone else and we have to pay to that person 2 lakh. This gentleman is getting 100,000, but the new one is going to get 200,000. We know that it will happen. So I have to adjust the PAT. I will deduct the additional salary. But we know that by paying additional 1 lakh, there will be additional tax saving as well. Because when we'll be making payment to our employees, so that salary is an expense, of course, but that results in tax saving also. So it means what I want to say that sustainable earning after tax means if we need to adjust the PAT, so we have to adjust the PAT as well. You are required to adjust the PAT also. Because if you're not adjusting the PAT and you are working on any outdated PAT, then obviously the business value will be with a big question mark. So when we are valuing a business on the basis of P ratio, then you need to know something about suitable P ratio and sustainable earnings after tax. If I really need to adjust the PAT, information will be given to you in exam. All you need is that you should be able to deal with that information. Now, there's one more way to value the business, which is the exactly inverse of P ratio. That is earnings yield. So another method of valuing the business is earnings yield. Earnings yield is the inverse of P ratio. That is EPS upon P naught. If you look at the P ratio, it was P naught upon EPS. Earnings yield is EPS upon P naught, which means that if we know the earnings yield and we know EPS, we can calculate P naught. P naught is equal to EPS upon earnings yield. Yield means return, or business value is equal to PAT upon earnings yield. Now you need to know one thing. Look at this P ratio formula. Answer comes in times P naught upon EPS. And look at this earnings yield. EPS upon P naught. Let's say we have APLC, we have BPLC. Assuming P ratio is 20 times, here P ratio is 12 times. So you can see one thing. APLC is having higher P ratio. BPLC is having lower P ratio. Great. If we have been given the P ratio, very easily we can calculate earning yield. Very easily we can calculate earning yield. Earnings yield is equal to 1 upon P ratio into 100. So you get the percentage. Let me use the calculator just to get the percentage. So that is 5%. Here I calculate the earnings yield. 1 upon 12 into 100. 8.33%. So please look at the relationship. The company which is having a higher P ratio is having a lower earnings yield as compared to the other organization. BPLC is having a lower P ratio as compared to APLC. But BPLC is having higher earnings yield as compared to APLC. You just need to know one thing, the inverse relationship. Okay, now there's one more method which is extremely important. Business value on the basis of free cash flow. A very detailed calculation obviously is not examinable in FM, but still free cash flow is examinable. Examiner will give you the free cash flow, but you need to know how to calculate the business value. Simply business value is equal to, let's say, free cash flows. There's no need to go into the detail. There are two types of free cash flows. One is free cash flow to firm, another is equity. That is in AFM. But simple concept of free cash flow is still examinable in FM. Free cash flows multiply by the growth rate. If examiner gives you the WACC, WACC minus growth rate. Now, By using this formula, whatever business value comes, logically that business value will be equal to market value equity plus market value of debt. By using above formula, whatever answer comes, that gives you the business value of market value equity plus market value debt. Why it gives us the business value? Why the business value here is equal to market value equity plus market value debt? Because we are using WACC. If you just recall, in weighted average cost of capital, the finance is not only coming from the shareholder, it is also coming from the debt holders. Now, examiner is asking you to calculate, now after calculating business value, let's say examiner is asking you to calculate market value equity. So from the total value, you need to deduct market value of debt. After deducting the market value of debt, you will get market value equity. Be careful if examiner gives you the free cash flows, but it is free cash flow which examiner has given you, the growth rate examiner has given you, but please now listen to me carefully. Examiner has not given you weighted average cost of capital. Let's say cost of capital is not in the question. In fact, instead of cost of capital, only K is there. If this is the case, then logically, whatever the business value comes, it will be equal to market value equity. So you have to read the data carefully. Either you have been given weighted average cost of capital, then business value will be equal to market value equity plus market value of debt. If you have been given KE, no cost of capital is given, then by using this free cash flow formula, you will be getting a business value that will be equal to market value equity. Now, what are we going to discuss in the next class? Let me just show you. I hope we have. Okay. In the coming class, which I'm expecting to conduct tomorrow, we will be discussing OTQs on this business valuation plus all means all multiple choice questions on business valuation from Kaplan kit. So in the next class, we'll be discussing OTQ and all the multiple choice questions from the Kaplan kit. We have already done a really big amount of question in our regular lectures, but just for the sake of revision, so the student, they can have a chance to attend, to discuss all the MCQs of Kaplan with me in live class. So I'll be conducting a class tomorrow. The topic is going to be OTQ plus all MCQs from Kaplan kit. So thank you very much for watching this lecture, and I'm expecting and hoping that everyone comes tomorrow. So I hope today's class has helped you a lot. And inshallah, the coming class in which we'll be discussing OTQ and MCQs, that will really help the students. Thank you very much.